Welcome to this video today, which is all about getting the right thought process to win at Forex trading. Now, in terms of most beginners who come in the markets, they think, yes, I'm going to be objective, I'm going to be disciplined, I'm going to be able to follow my trading plan. Then, when they start trading, they find out they're not as objective as they want to be. They find out that discipline breaks down, and they often fail to see things they should have seen. Okay, and after the event, they think, "Yeah, I should have done that," and they didn't. Why? Well, in terms of forex trading, you need a certain thought process, and I'm going to illustrate the type of thought process you need by posing two questions. Now, see if you can get the questions right. The questions are actually very easy in terms of anyone can get them right. They're not complicated. They're simple questions. One, a simple mathematical problem, and one is to do with flowers and roses. Now, these two questions are posed by behavioural psychologists to show people they're not as objective as they think that they are. Okay, now what I want to do is pose the questions. You can see if you can get them right, and then I'm going to discuss their relevance to forex trading. Now, the first question is coming up. I'm going to give it to you right now. I'm going to leave it with you for 10 seconds on a storyboard. Think about the answer. See if you can get it correct. Here is the question. A bat and a ball together costs $1.10. The bat costs $1 more than the ball. So how much does the ball cost? Here's the question again. Think about it carefully and then think about your answer. Then we'll be back to discuss. Welcome back after that short question there. Now, did you get it right? If you did, congratulations, you're in a small minority. That 80% failure rate is Harvard graduates. Asked the question at Forex seminars, failure rate has been even higher when I've done it, 90%. Yet that question is very, very easy if you use the right thought process. Bat and the ball, it cannot be the ball is 10 cents. If you work it back, you can see that, and then you can see the right answer. Bat costs $1 more than the ball. So the bat costs $1.05, okay, $1 more than the ball. Then you add the price of the ball in, 5 cents, 1.10. Very simple. Now, even when I explain that to a lot of people when they've got the question wrong, they still look bemused. It's because they've got the wrong thought process, and it's got nothing to do with intelligence getting that question right. It's very easy. Before I did a Forex seminar, I once asked a young trainee girl, not the brightest girl in the world, when I was in the hairdressers, asked her the question, just asking everyone I could find. She thought about it for 2 seconds, got the right answer, and looked at me as if to say, why are you asking me such a simple question? Now, I want to pose another question. Now, see if you can get this one right. It should be easier now you've seen the previous question. Just going to pose the question again on a short storyboard. Think about your answer and why you've made the answer. Then read the quote that I've put after the question from Daniel Kahneman, and you'll see why so many people get these simple questions wrong. Then what we're going to do is just relate this to Forex trading because it's very, very relevant. Right, here's the question. I'll be back in a moment. I will come back after that question and the quote. Now, in terms of the question, did you get it right? Congratulations if you did, because again, most people fail to get that question right. The premises are obviously not true. Why? Because some flowers does not have to include roses, does it? Now, in terms of Kalaman's quote, what he is putting over is basically that when we basically make decisions, okay, we find it very hard to question the obvious. Not only do we find it hard to question the obvious once we've accepted something as true, we also will not override or fail to override a number of cognitive biases that are programmed within us. Okay, now this does happen in Forex trading as well. Okay, so if you got those questions wrong, then what I'm going to discuss now is very, very relevant. Okay, and you should keep the points in mind when you are learning Forex and also when you are trading in the markets. Let's go to another storyboard and I'll go through some examples. Right, let's have a look at how to get the right thought process and make money at Forex trading. And in terms of the right thought process, we saw there's two easy questions earlier on that most people get wrong because they have the wrong thought process. You have that thought process in Forex trading, you're definitely gonna lose. And you know what you must do is always be aware of the obvious. Okay, in terms of you see something like those questions, the answers look obvious. You form an opinion and then you don't check the opinion back. You've got to check your opinion back. Okay, now in terms of both those questions, what's interesting is they both exploit pattern bias. Okay, they're written in a certain way to give you a pattern to fool you into giving the wrong answer. Okay, you look back at them, you see what I mean. Now, we all know humans love patterns. We're always looking for patterns. It's genetically within us. Okay, now when traders come to learn Forex trading, what do most beginners want to do? They want to learn the best patterns to make money. Now you can go around online and you'll see plenty of people teaching pattern trading. It's intricate, normally lots of lines, it's very predictive, looks very convincing. It's only convincing with the benefit of hindsight. It doesn't work in the real world. Okay, do your research and look back and see it obviously doesn't work. Done plenty of videos on this. Any technical analysis should be very simple, not based on pretty patterns or prediction, but on price reaction on key levels. Okay, that's just one example. Now, when you're learning, if it looks too easy to make money or it looks too obvious, you've got to work backwards and test it for yourself, just like people should have done with those questions earlier. They don't most of the time. They just accept what they're told, come in the markets and lose money. Now let's take your trades in the market when you're trading your strategy. Even if it's a soundly based strategy, you're going to have to make cognitive effort, as Daniel Kahneman would call it. What does cognitive effort mean? It means that you have to overcome the cognitive biases within you that basically, unless you're aware of them, unless you override them, are going to cause you to do the wrong things. Let's just take a trade being taken in the market. You make an opinion, or you've got an opinion, you make the trade on that opinion. Now, the biases that are going to come straight in are mental inertia and the confirmation bias. Now, what's mental inertia? Mental inertia means that once you've formed an opinion, it takes a big impetus to change that opinion. Once you set an opinion, you want to keep it. Okay, so that's mental inertia. You don't want to change it. But even worse, what you're going to do is you're going to suffer from confirmation bias. So let's say the trade is going against you. You're not going to look for reasons why the trade is wrong. You're going to be looking for confirming evidence that it's right. Now, Jim Leitner, I did a video the other week on him, said it's one of the hardest things to do in Forex trading. Think why your trade could go wrong or is wrong, rather than the reasons it could be right. You've always got to be aware of when your trade is wrong so you can get out of it, okay? It's very hard for most traders to do this. They want to confirm their opinion, not disprove it, okay? So those two biases will very often mean that traders hold losing trades when the reality is they shouldn't. They just needed to overcome those biases. Now, when you're holding a trade as well, you do have what's called anchoring bias and sunk cost fallacy come into play. What's anchoring bias? Well, we anchor things, okay? And by anchoring, what we do is we anchor to the price we've entered. That's the important price to us, okay? Now, let's say, the market is moving against the trade. How often do you hear a trader say, I'll just wait till I get back to break even, then I'll get out? That's totally illogical. Why wait to get back to break even? It's probably not going to come there. But the anchor is the entry price. I'll come to another example of anchoring in a moment. Sunk cost fallacy. Again, a very illogical bias. What it means is that you don't see a loss until the trade is closed. Okay? When it's open, it's not seen as a loss. Okay? Of course it's a loss. If it's open or it's closed, the negative is the negative. So this is where hope comes into play, and the trader hopes the trade turns around before it's closed and comes back to profit. But you can see, once you're in a trade, you are fighting those cognitive biases, okay? Which will, for most traders, cause them to hang on to losing trades. Now, a lot of traders will obviously snatch profits early, which you shouldn't do, because obviously you need to run your profits and obviously cut your losses. But what happens when a trade is snatched? Well, when it's taken in early, it is risk aversion and recency bias. Now, risk aversion basically means that we are risk averse as humans. We hate losing overall, okay? I think most people would gather that. However, we fear losing more than winning, okay? Now, that might sound paradoxical, but what it means is when we've got a profit, the profit is there. Let's say the market looks really good. The trade looks like it's going to be going on. Small retracement, okay? Risk aversion, the fear of loss, then comes into play and means the trader thinks, I better snatch that profit in before it turns into a loss. So trade gets taken in early. Risk aversion works also when we're holding losses, okay? We're so frightened of losses, we just don't want to take them. We either want to get back to the anchor or into profit. So what risk aversion actually does is cause traders to run losses and snatch their profits early. Now, in terms of a trade being snatched, recency bias also comes into play. This means the human brain pays more attention to the most recent information. So if there's like a little small retracement in a big trend, and let's say you're looking at it on a screen, trade drops, let's say 50 pips in a few seconds, that information then becomes very important. More important than the fact that you could be making several hundred pips if you held on to the trade, or you got a few hundred pips already. That recent small move has a bigger importance to you because it's so recent. That again can cause the trade to be snatched. Right. Trades missed. How many traders see a move start, okay? Say it's a breakout to the upside. They think that trade is going to continue, but they won't take the trade. Okay, they want a better price. Okay, they want a pullback. Now that's where anchoring comes in again. The anchor then, in terms of the trader, is the lower price. That's the important price. That's the price he wants. So he's going to wait for it, but he's probably not going to get it if it's a good breakout. It's a bit similar, obviously when we saw earlier on, the anchor is the entry price. Trader wants it to come back to the anchor. Very often it just doesn't come back to the anchor. Okay, so you've got to overcome that as well. And basically, if the trade looks good, just go in and take it. Finally, any opinions are subject to availability and herding bias as well. Humans are naturally sociable beings. We like to trade with others, and let's say we see a lot of convincing news stories of why a currency pair should go up, from learned experts, so to speak, then we actually think, oh, that might be a good trade, or certainly all the beginners do. But go in with the comfortable option, the majority. So it's herding bias as well coming into play. This is another thing we need to question what is given to you. Okay, if everyone thinks something is going to happen, think of what might happen to prove that opinion wrong. In Forex trading, you don't want to be with the majority for obvious reasons, because it's only a small minority that win. So when you've got your trades in the market, it's cognitive effort to keep all those biases out, see the reality, and see the truth. And like I've said earlier on, question everything back. Just don't hold an opinion. Okay, question it. Okay, you've got to work any trade you've got through continually. When you're learning the markets, question everything. Don't be lazy in terms of the way you think. And go back to those two questions again. People just didn't make the effort to try and answer them. It wasn't that they couldn't answer them. Now, that's just a very brief introduction, in terms of cognitive biases. Now they work against you. I've done other videos on them. You can look them up. Also, I would recommend some excellent books to go and read. Perhaps the best book to read on how your brain really works is Daniel Kahneman's Thinking Fast and Thinking Slow. And if you think that humans are basically objective and logical, read the book. You'll realise why they're not, and why you will struggle to be too, unless you're very aware of the biases that I've mentioned, and a few more as well. In terms of a trading book, which is also very good in terms of talking about biases in respect of trading, is Curtis Faith's excellent book, which is called Trading Instincts. So that is the video for today. I hope you enjoyed it. Thank you very much for watching me as per usual.